Hello everyone, we are Group 4. For the introduction part, a global shift from traditional streamer like Netflix and Disney Plus to short-form platform apps has slashed their viewership and ad revenue, with advertisers tracing audience to mobile-first apps at berated notes. This evolving behavior undermined the subscription model viability, following the scrutiny over how firms account for media assets, including debit over big bath practice. So here's a real-world example of the big bath. In Q3 financial year 2023, Disney announced a US $1.5 billion non-cash impairment charge, primarily from removing 50-plus titles from Disney Plus and Hulu, including Willow and Dollface. Management described this as strategic content review, citing shift in streaming demand and competition from TikTok and YouTube. However, analytics raised concern that the charge may have included forward-looking provision, for example, impairment content before full commercial value, suggesting a potential big bath. This tactic allowed firms to concentrate loss in a poor year, so future periods appear more profitable, a hallmark of the big bath accounting. Indeed, in financial year 2024, this is direct-to-customer segment post an operating profit of US $47 million, reversing P&L losses of US $587 million. Total streaming loss shrunk to US $18 million, with lower amortization costs and no similar write-downs, contributing to a 30 to 35% raise in adjusted EPS. This trend occurred despite only moderated subscribers growth, reinforcing the earnings smoothing effect. While the write-downs may be justifiable, the timing, size, and future earning impact the suggest earning management motivate. So Disney's leverage a weak quarter to reset the expectation, using big bath of an income decreasing strategy used to benefit the future period. And now I will pass it to Larry Zhou to have further analyze.
Hi, I'm Larry Zolu. Today I will briefly explain the four main advantages in allowing managers flexibility to record asset impairments in their financial reporting, adding real-world evidence to support each point. First of all, impairments bring home the bacon. As Bharat points out, digital platforms like YouTube and TikTok are quite overtaking traditional media revenues from advertising. In addition, the statistics chart shows that all ad spent today, digital already accounts for two-thirds. Being early in recognizing impairment merely reflects this economic shift. Secondly, it makes financial information more relevant. Wellington argues that management flexibility helps managers communicate more useful information, particularly in the face of industrial shocks. An example from Merkle Capital's study of banks shows how impairments were used during times of volatility as a basis for asset strategies reorientation. Thirdly, impairments facilitate strategy repositioning. With an early acknowledgement of losses, enterprise can halt or turn around their direction and embrace a fresh one. Data on European banks from ResearchGate confirms that heavy impairment charges during the global financial crisis lead to major structural reforms. And finally, impairments can add earnings management. This concept is prone to abuse, but may also be transparently employed to restore investors' confidence. As this seen in the CPA journal image below, you can see the company use big bus techniques to restate all bad news, building a clean basis for future recovery. Okay, for next part, I'm gonna pass it to Angela.
Now let's look at the accounting side of Apple's acquisition of WBD. First, under IFRS 3 business combinations, Apple would apply the acquisition method. On the acquisition date, Apple would measure the fair value of consideration and allocate it to identifiable assets and liabilities, likely resulting in goodwill due to control premium. Second, WBD's content libraries, trademarks, and customer relationships qualify as identifiable intangible assets. Streaming licenses are amortized over contractual periods, whereas indefinite-lived trademarks are not amortized but tested annually for impairment. Third, funding a large acquisition often involves significant debt financing. The current enterprise value for WBD is $65 billion. While Apple ended second quarter of 2025 with $28 billion, As such, Apple is very likely to record new borrowings on its balance sheet. The interest expense will impact Apple's profitability and leverage. Fourth, post-acquisition impairment testing under IAS 36 is required. Goodwill and indefinite-lived intangibles are not amortized but tested at least annually, or more often if impairment indicators, such as declining industry viewership, exist. If recoverable amounts fall below a carrying amount, impairment losses must be recognized, reducing goodwill and hitting the income statement, which could enable a big bet in a downturn. Overall, while the acquisition would create synergies, cross-promotional IP licensing, hardware bundling, and advertising, the management retains significant judgment in fair value allocations, amortization schedules, and impairment assumptions. Auditors and investors must scrutinize these estimates to ensure transparency. Now I will pass it to Paul.
Hello everyone, my name is Xihao Xu. If Apple acquires Warner Bros. Discovery in 2025, it will add billions in goodwill and other intangibles, HBO's brand, its content library and customer ties to the balance sheet. Under IAS 36, these assets must be tested for impairment every year. Why does that matter? Deloitte predicts the average number of paid streaming subscription per household will start falling from 2025 for peer play streamers. Impairment risk is high. After its 2022 merger, WBD vote of $5.3 billion of content in one hit. A textbook big bets that without a year's profit and shocked investors. A similar goodwill write down at Apple would slash net income, unsettle a debit covenant, and send the share price swinging. Big one-off charges also distort comparisons, letting managers reset expectations without fixing the core issue. In short, if viewers keep shifting to other platforms, Apple's post-deal earnings could become far more unstable, and its balance sheet much weaker, unless disclosure rules tighten or Apple adopts a steady amortization plan for streaming rights. And next, welcome, Bro.
As discussed, traditional streaming is currently under pressure. As we look into the future of media consumption, the trend towards video app viewing is unlikely to reverse. Platforms like YouTube and TikTok won't just be a shift in the short term. They reflect a broader and generational change in how younger audiences prefer to view content. According to an article published by ABC in 2025, it was reported that 56% of Gen Zs find social media content more relevant to their interests than film and television. Given that these video apps also have the leverage of personalizing user algorithms, it is more likely that these platforms will target content precisely tailored to each consumer's interests. Consequently, user engagement will improve across these platforms, with forecasts suggesting that short-form media will account for 83% of total ad spending by 2029. In conclusion, for major streaming services such as Apple Inc., this future trend presents a structural challenge. The value of the assets it would inherit, such as HBO Max's content library, Max Originals, and other Warner Bros. Discovery streaming channels, may potentially weaken over time if it acquires Warner Bros. Discovery in 2025. Whilst these assets are expected to generate future revenue, their performance may trend below expectations if fewer people continue to engage with traditional streaming. Hence, Apple could face ongoing issues, not just in the form of one-off impairments, but in the gradual underperformance of those assets. Therefore, as traditional streaming becomes less dominant in how people consume entertainment, these assets may not deliver the revenue influence as they were intended to if they were to be fairly valued for at acquisition. Please see our references attached on the next two slides. Thank you for listening.